Hello and welcome to Modi 365, the Street View. It's time to look back and analyze what the current administration has managed to achieve in last 1 year. The street is divided and opinion is split right in the middle. An optimistic would say that the rate of change is evident. A pessimist would insist that rate of the change is slow and Indian economy is yet to recover. But my guest on the show is someone who has always believed that you should invest in a market when there is value, and he's someone who has identified not one but several multi-bagger ideas in last 2 or 3 years, starting from Symphony to persistent systems and Tata Lexi. Nilesh Shah of Envision joins me on the show. Nilesh, fantastic to have you back and thank you for joining us. Well, the mood point is 1 year into the new administration, how are things looking? Optimistic would insist that the rate of change is evident. A bearish person would say the rate of change is very slow and anemic.
Well, I probably believe that we started last year, exactly a year back, on a very high hope. It was more about lots of intent. In the middle of the year, we clearly saw a lot of ideas taking shape. And I think going forward, it's going to be now years of implementation and years of execution. To be very honest, I think a year back, we probably hoped for higher growth rates, but really weren't too sure how these higher growth rates would actually materialize. I'd probably say that today, one is really more sanguine about how those higher growth rates would actually come about. And it looks like that a lot of ideas and initiatives which the government has unfolded over the last 1 or 2 quarters, I think will have a material impact on our growth rates over the next couple of years or so.
But there is some degree of disappointment that the original India thesis has cracked. Earnings are yet to recover, interest rate transmission has not started, valuations are looking stretched, and at the macro front, barring crude, there is no real on-ground recovery.
Well, again, I think that's probably partly true and partly not true. If you really look at on the ground, there are some sectors where the improvement is perceptible. And I clearly believe that, for example, roads as a sector is one area where the level of confidence is vastly different from where it was a year back. And I think probably a few more sectors will follow course. Maybe the power sector is the next sector where you could again see a lot of changes. But I don't think this is so much about an individual sector or not. But I think a lot of initiatives which have been taken, I think are going to have a significant impact. Clearly, the whole initiative to have more and more Indians come into the mainstream banking system, for example, I think is very, very important. Insurance for all, housing for all. I think these are some of the very, very important initiatives which I think will drive per capita income and get Indians to basically consume more and improve their overall quality lifestyle. And when that begins to happen, you could clearly see the economy grow into a very different trajectory. And I think at that point of time, the optimism and the confidence would be at a very different level versus what it is now.
GST, land bill, 2 major setbacks for the current government.
I'd probably say that yes, that they may not be setbacks, but yes, there are clearly delays. I think the street just expected that the GST bill would get introduced and it would get passed. Clearly for the rest of this financial year, I think it is GST, the land and the labor side. These are the 3 big areas which the street as well as the economists are expecting the government to really move seriously forward. And clearly these 3 are going to be the most important events or triggers for the future. These are going to be the 3 big reform credentials of this government. But I clearly believe that there could be still some more delay there. It's not something which is going to get passed necessarily in the monsoon session. If it passes, great. But I think a lot of initiatives which have really taken place, as I was mentioning earlier in terms of housing for all or bank accounts for all or insurance for all, or for that matter, auctions or expediting clearances. I think these are some of the things which you would begin to see the impact of all of that in this financial year. And going forward over the next 2 or 3 years, the impact of GST or the reforms on the land or the labor side will have a very positive effect on the economy and on our growth rates.
There seems to be a degree of disappointment. There seems to be a degree of disenchantment when it comes to the earning pickup. We are in a bull market, but the earnings growth or the earnings trajectory is reminding me of a bear market scenario.
Well, I'd probably say that that the whole recovery process in terms of the earnings recoveries probably got extended maybe by a couple of quarters. So clearly FY15, really the year which has gone by, nobody really expected earnings recovery to happen in any big bang manner. I think clearly it was FY16 where investors, market participants started to believe that Q1 FY16 is really going to be a breakout quarter. That's really when the recovery will start. But that's perhaps now got pushed by a couple of quarters. So instead of Q1, I probably believe that that recovery process in earnings will start somewhere around the end of H1. So from Q1, I think it shifted to virtually the H1. And I'd probably believe that there's a good chance that it will start from there, because the impact of falling interest rates, the impact of falling raw material prices, I think these will start to tell from maybe Q3, Q4 onwards. And given that we are now dealing with a relatively lower base, I'd probably attach a very high degree of probability to really the earnings recovery to start from H2 of this financial year.
Nilesh, but if I run through your current holdings, the stocks which you own, the stocks where you're shopping, they've got very little economic correlation or economic connection. IT companies, consumer names, exporters. Why is that? If you're so confident of economic recovery, you should be buying cyclicals and industrials.
So Nikunj, I think clearly, I think as a value investor, it's very important to kind of, break this myth about a strong correlation between GDP growth and the stock market cycle. I mean, clearly, if you look at the US, over the last 5 to 7 years, I mean, if you really look at the annualized growth rate, it's probably about 1% GDP growth. There have been years of maybe negative growth, there have been years of flat growth, and maybe years of 2, 3, 4% growth. But all in all, maybe that annualized growth rate has just been about 1 to 2%. But look at what the markets have done, and look at what pockets within the market have done. So there are a whole host of companies which have basically been very optimal utilizers of capital, have been running a very lean balance sheet, have been innovating continuously, and have been doing things in a very different kind of a manner. And I think that's clearly where a lot of value gets generated for the investors. What we clearly believe is that even despite the very difficult times that the economy has been facing, sectors like technology, pharmaceuticals, consumer, or engineering-oriented companies, these are the kind of sectors which have continued to do well, and especially companies within that, and especially managements within that, who have basically executed a very differentiated business strategy. And I think that really creates the alpha for the investors. A very higher GDP growth only provides you the tailwinds, but otherwise you need businesses and balance sheets which can counter the headwinds, be it global or local. And I think clearly, therefore, we still believe that sectors like technology, pharmaceuticals, consumer, and select engineering-oriented companies, these are the kind of sectors or companies which will continue to be the cornerstone of wealth creation in India. On the other hand, yes, there would be companies which are from the material sector, the infrastructure sector, the commodities play. They could be there. They could provide you the beta in the intermediate space. But clearly, we continue to believe that you need to really necessarily be biased towards the sectors like consumer or technology or pharmaceuticals.
That's not value investing, because the sectors you mentioned are perhaps priced to perfection. In some of the key consumer names or pharma names, growth is slowing down and valuations are expanding.
Yes, so I clearly believe that, yes, of course, these are sectors which have done remarkably well in the last 3 to 4 years, and valuations have becoming extremely challenging out there. But what we clearly see is that our strategy has been that really don't go for some of those headline companies which are, the number 1, number 2 players in some of the very obvious sectors. Maybe within that, look out for subsegments, look out for niches, look out for companies again who have a very differentiated business model, a very differentiated execution. And I think if valuations are at reasonable, and here I mean when I say reasonable, it need not mean single-digit P multiples, but it could be also valuations which are at a steep discount to some of the bigger names. I think if one really looks for that across sectors, so clearly I think when we looked at any of these companies which we've invested in, be it a Tata Elxsi or a Persistent or a Symphony, I think what we clearly saw in each one of these companies at different points of time is that these were companies which were probably, you could bracket them as a consumer company or a technology company, but they were dealing with individual business segments. And I think that really kind of had its own share of appeal. Okay, maybe today valuations, of course, in a lot of them are on the higher side. But for example, when we've invested recently in a company called Kolte Patil, I think clearly that is in real estate, but to us that's discretionary consumer business, where you really are looking for providing quality households to Indian families. And clearly we see that here is a company which is trying to do business in a differentiated manner in terms of sticking to its core areas, having a decently lean balance sheet, and addressing most of the softer issues that an investor would want to really look at from a potential wealth creating company. Yeah, so I think clearly you could easily say that yes, there is a real estate company, but I think within even a real estate sector, if you identify a niche like residential segment, and within that if you can look at companies which are doing business in a very differentiated manner with a lighter balance sheet, I think that becomes a very strong candidate. Timing could be very difficult. You probably are not able to time it from a purely quarter that when is the inflection point, but I think whenever discretionary demand picks up, clearly believe that companies like this would clearly be the growth frontiers at that point of time.
When do you think discretionary demand will come back? For discretionary demand to come back, rate transmission has to happen, economy has to pick up, and perhaps more savings have to get created.
Well, what we are seeing is that discretionary demand is picking up in some way or the other. So for example, last year was a great year for the consumer durable guys. So you look at all the companies which sell ACs or air conditioners or air coolers or refrigerators, washing machines. I think it was a great year for them, irrespective. 2 years before that was a great year for a company like Titan, right? So I think discretionary demand, I don't think everything moves in together. You clearly see cycles of growth. But I think across the board, linear growth or linear revival in discretionary consumer spend is probably a year away. Even within the course of this year, you could see some pockets of strength, but probably FY17 onwards will be really the year when you could see across the board boost in discretionary demand.
Just and discretionary. Autos broadly.
Autos, consumer durables, jewelry, fashion, apparel. I think these are all the years, because I think what I see right now is that rate cuts have started, but the rate cut has not been enough. We probably still need some way to go before we could actually say that here is where the consumer will step in and buy. Job creation is still kind of anemic. Salary hikes, wage hikes are still muted. There is stress on the rural economy, and I'm quite sure that especially families and households which are connected to agriculture are probably going to wait for a normal monsoon to happen and a reasonably good harvest to really happen to start spending aggressively. So it looks very likely that the next 2-3 quarters are going to be challenging for this whole segment. But our sense is that probably the next financial year is when you could actually see a huge push-up happening. Also, I think yet the gains which companies or producers are having in terms of lower raw material costs have not yet fully got passed on. Most of the companies are still spending big bang on advertising, on sales, distribution, all of that. And you would actually see consumer response getting more favorable to all these initiatives, maybe from the next financial year. So I think that probably is going to be a very, very important year.
Nilesh, markets, they simply love to hate PSU stocks. But the Modi government is doing the right things in cleaning up the entire banking system, especially PSU banks. There is talk of efficient lending. Get professionals at the top. Be easy on loan disbursement, but be careful when you are giving out that loan. Is that sector on cusp of recovery? And as a value investor, simply because what the current government is doing, are PSU banks a value buy?
It really depends on the kind of time frame. But I think, yes, a lot of stuff has happened, but clearly a lot of the initiatives, especially all the recommendations of the NAIC committee, I still think are yet to be kind of adopted or accepted and implemented. And I clearly believe that it's only when that happens will you really say that the worst is over for the PSU banking space. It looks like that maybe in maybe a quarter or two, the deterioration in the asset quality might get contained.
But that's not a good enough reason for you to buy them.
But it may not be a good enough reason, because I think the big challenge for PSU banks is going to be capital infusion. I think in the right manner, this government has actually gone in and said that we will give capital to only the deserving candidates.
Just 4 or 5 names.
Exactly. And I think that's clearly where the challenge is.
So the government message is that I will only protect 4 or 5 banks, and as an investor, then why should one really go beyond that?
So you really don't know what is going to be the fate of the other banks. If it was very clear that the government is pretty comfortable letting their own stake fall below, the control thresholds, then I think they become strong investment candidates, because you know that private capital is going to come in, institutional capital is going to come in, engineer some of the changes and reforms that are required at the micro level for each of these banks, then yes, I think they become excellent investment candidates from a value point of view. But till that does not happen, it's still tough to really take a call as a value investor as to really when this change will happen. So I think one needs to really watch the space.
But Nilesh, financials give you the closest proxy to any economic recovery. A big economic recovery is now staring at us, and soon it will be a reality. It could be 2 quarters, it could be 4 quarters, it could be 6 quarters, that's debatable. So one is not buying PSU banks. What should one buy into financials? Private banks are already expensive. PSU banks are a must avoid. Then how does one participate in the economic recovery?
So I clearly believe that one important pocket of financials is clearly the NBFC space. I think that's clearly...
Do you own any names there?
Well, what we own out there is IDFC, which is today classified still as an infrastructure institution.
That's a new name.
Or as an NBFC, but I think it becomes a bank a few months down the line. We believe clearly that it offers the best of both worlds. That on one hand, it has basically the management of a private sector enterprise, a management which has proven itself in terms of how do you manage a balance sheet in difficult time, how do you really navigate during turbulent times. So I think full credit to the management to basically keep the asset quality intact so far. Its transition and transformation to a bank helps it basically to really tap a lot of other growth areas and provide a complete solution to a customer, which is not just about giving a loan, but having bank account, cash management, and all of those things. So I think if one has a 3 to 5 year horizon, okay, I probably think that from an absolute return perspective, it offers one of the best risk-reward characteristics or profile that a value investor would really look for.
We take the clock back and we have got some excellent examples in front of us. The migration of Kotak Mahindra Finance into Kotak Mahindra Bank, and that has been an excellent migration. But when IDFC is planning to become a bank or is planning to migrate into a bank, the landscape also has changed. The landscape is extremely competitive. Can an IDFC do what a Kotak Mahindra Finance did or what a Yes Bank has managed to achieve?
Well, surely, because we're still talking about a handful of private sector banks. I mean, we're today now a $2 trillion economy catering to 1.2 billion people. And within that, we're talking about, not even half a dozen, world-class private sector banks. I mean, all of them put together are just a handful, which really is not in the right spirit.
So the whole spirit of financial inclusion now fits in here.
So absolutely. So number one. Number two is that it depends on how you look at it. The private sector segment is probably still about 20 to 25% of India's banking system. The public sector accounts still for 70 to 75%. So I think a new bank in this entire arena should really not be eyeing for that 25%, which is the smaller pie, should be eyeing for that 75%.
That's the honeypot.
That's the sweet spot, that's the honeypot, that's the low-hanging fruit, that the incumbents out there in that 75% are having their own headwinds, they have their own challenges, many of them are structural in nature, it might take some time for them to transform, but in between, there is a pocket for all the private sector banks to really go in and increase the market share. And I think that's clearly where there is a huge growth opportunity. So the market need not be created. There is a low-hanging fruit out there. There is a market. It's just for you to step in and take away some share.
The second big theme of the current government or the Modi government is going digital. And you have made some investments there, Tata Elxsi and Persistent. They've made money for you. They've been multi-baggers for you. Are you happy to own them?
Oh, absolutely. I think we are very happy to own both of these companies. We continue to own both of them. I think what they're really focused on is basically digitally transforming enterprises, which means really digitally transforming their enterprises, their customers to whom they cater to. So you're really betting on the enablers, that here are these companies which are enabling their customers to transform digitally. And then you probably also look at companies which themselves are transforming digitally, adopting the digital mode to really connect with the young India, the aspirational Indians, and then grow out there. So that's going to be a very, very interesting segment to really watch out for.
So this theme has a long way to go.
Oh, absolutely. I probably believe this is just the start. And I think the way we've seen actually Indians move from just pure computers to laptops and finally to mobile, I clearly believe that here you're going to see a lot of companies embrace the digital path to basically reach out to their customers, delight customers, and then grow in a disproportionate manner. And I think and faster companies realize this, I think the better it would be for them.
Now the Modi government is also trying to bring it's working on really ease of business. Their Made in India campaign so far has been a resounding success. India does not have a very strong historical advantage when it comes to manufacturing. So how does one participate in this entire area?
I probably believe that over the next 2 to 3 years, the big change which will happen really is on the manufacturing side and on the Make in India. And actually all the initiatives which have which have come out in the last 2-3 months have really been focused on that. So for example, what the finance minister said in the budget in terms of the new bankruptcy law, okay?
Big change.
I think that's a huge thing. What is going to be key is how fast can the government legislate?
Black money, again, game changer.
So that black money, I think, is a huge positive. 3 is basically the whole decision that we basically do away with approvals. You come up with a set of pre-approved criterias. And if you can set up a factory or you can start a project which match those criteria, you actually don't need approvals. Now, I think these are really game-changing ideas. GST, I think, again, that is very, very, very positive. So I clearly believe that this is really going to be a big focus area. I think the whole focus on skill development, I think I heard a lot of intent a year back, but I'm not too sure whether enough is happening. But clearly, skill development is one area where a lot needs to be done. If you have millions getting into the job market, that's one important area. And I clearly believe if we don't skill ourselves, we will kill ourselves. And I think that's going to be very, very important. So I think there are a lot of initiatives which you will see the impact of that over the next few years.
So broadly, if you have to summarize today's interaction, your assessment is that as of now, markets are just taking a pause. There's nothing wrong. This is healthy consolidation. We should not consider the current bout of volatility as some kind of a trend reversal.
Oh, absolutely not. Clearly, the uptrend is very much intact. It's just that we are probably doing some kind of corrections or reversals of the strong up move.
Just course correction.
It's just purely course correction, and I still think that the uptrend is still pretty much intact. And I clearly see that the earnings growth, the double-digit earnings growth, India is probably closer to the cusp, if not at the cusp of that. And I clearly believe that over the next 3 to 5 years are going to be very, very exciting times.
Client walks up to you, he gives you $1 million check, he wants 3 ideas.
Well, I'm not too sure about whether $1 million should be just invested in 3 ideas, but I can just talk about some of our recent investments where we are very sanguine about their prospects over the next 3 to 5 years. So I think clearly IDFC, which I mentioned earlier in the show, we own this. Clearly from the digital side, we believe that Mahindra Holidays has an excellent pedigree and it's taking the right digital initiatives to reach out to the young aspirational Indians. And third clearly is again on the real estate side, we like Kolte Patil. I think these are the 3 ideas which we believe that risk reward is very favorable from a 3 to 5 year perspective. 2
old, 1 new, but I'll not insist on anymore. Let's get some disclosures going before we wrap the show.
Yeah, so Nikunj, we own all the names that we mentioned on the show. We own of them. We have a vested interest in them. So your viewers need to basically take their own decisions before investing in these companies.
Fantastic, and always a pleasure to have you back on Market Makers, and especially on this special edition of Market Makers, Modi 365, The Street View.
Thank you, Nikunj. Thank you so much.
That's it on the show. I'm Nikunj Dalmia signing off. Thank you for watching the show and thank you for joining us.